Okay, welcome. Yes, I am the host of a radio show that's gained a lot in popularity called Turning Hard Times into Good Times, and you can, the best way to follow that is to go to a website called jtaylormedia.com. That's J-A-Y, taylormedia.com. And from there you can access the radio show, video work that I do, my own newsletter, as well as two partners of mine, Chen Lin and Roger Wiegand. So that's a little bit of a commercial to get started here. Let me get into the meat of my talk. I've titled my talk, Why Gold Mining Shares Are the Buy of a Lifetime. I'd like to ask how many of you might have heard Ian Gordon's talk earlier this morning, if I could see a show of hands. A few of you. Well, I think what we're looking at, and the reason that gold and gold shares are the buy of a lifetime, is because we are in a massive credit correction process, a credit deflation process. And historically, whenever this has happened, the real price of gold, not necessarily, I'm not interested in the nominal price of gold, but what an ounce of gold will buy, rises dramatically. And as that happens, the mining companies do well because their profit margins surge. Profit and capital flows into the mining industry, which is definitely happening right now, into the gold and precious metals sector. And then there's a huge amount of exploration. It's a very exciting time. This is, I'm 64 years of age. This is the most bullish, this is the bull market of my lifetime for sure. Okay, so I just want to bring your attention to Chen Lin, who is a brilliant stock picker. He is a partner of mine, and Chen will be joining me tomorrow in my workshop. So those of you who can come around, Chen will share the time with me. Just this is an illustration of a fund that we an IRA, his wife's IRA that we track. He started out with $5,400 in 2003 and turned it into $1.5 million by the end of last year. It's a little bit higher now. It's about $1,550,000. So Chen is a brilliant stock picker. He'll tell you, he'll give you some of his ideas and some of his picks tomorrow in my workshop. Okay, this is a chart you've probably seen if you were here with Ian Gordon. It is a chart that shows the real data of the Kondratiev cycle going back to the Revolutionary War. And what you see there is the top line is the stock market cycles in the United States. You'll see a gold line there that tracks the gold price, or a proxy of it in the form of Homestake. You'll see commodity prices at the bottom. You'll see interest rates. But what the point of this is, there's a great deal of detail here, but we don't have time to go into detail. What we're looking at is the fact that these long cycles, you have these credit expansion cycles, and then the credit system gets so indebted that the debt can no longer be repaid. I heard part of Ian's speech a little earlier, and he said, that's when this credit cycle, when the paper monetary system ends, is when it is expanded to the point there's so much debt that it can no longer be repaid. And that's really where we're at now. And so it's taking more and more money faster and faster, printing press money, helicopter money from Ben Bernanke, to try to keep the system afloat. And I think we're coming quickly to an end. But the main point is, and as I'll show you as I get on with my talk, that the real price of gold has been rising very dramatically, especially since the Lehman Brothers collapse in 2008 and the first leg down of what I think is going to be more major credit deflations and more major recessions ahead of us. I think this is the most important slide I'll show you. It shows total debt to GDP. And we can see the almost exponential rise of the red line, which is total debt. This is all sectors of the American economy. It's the federal government, it's state and local governments, it's private, it's credit cards, it's corporate, it's all sectors. And you'll notice a little bit of a curl over at the top. Well, that was our Great Recession, the biggest decline that we've had since the Great Depression. And all it's really done is just very minimally corrected this gap between GDP and debt. So the point is that as debt is growing so much more rapidly than income, every time Mr. Bernanke goes out and prints more money, he's creating more debt, because debt is the raw material from which